What are intangible assets and how do firms account for them? In this video, I will introduce this important category of assets and I will talk about how accounting differs based on whether you develop these intangible assets internally or whether you purchase them from an external party. Intangible assets are long-lived productive assets that have two characteristics. Number one, they lack physical substance. You cannot touch them as you can touch a building, computer, land, etc. Second, they're not financial instruments, meaning there is no contractual claims associated with them. Intangible assets are often a really important part of the strategic positioning and advantages of the company. However, we do have a limitation in terms of our financial statement presentation. Namely, intangible assets are not reflected on the balance sheet at their fair value, at their full value. Let's take a look at a couple of important intangible assets that we're all probably familiar with. Coca-Cola has a secret formula that drives the manufacturing of their drink. Disney has a lot of brand recognition, a lot of copyrights, a lot of intangible assets. IBM has one of the biggest patent portfolios among US companies. So on the balance sheet, if we go to the asset section of these companies, we're not going to find these intangible assets represented at their fair value. Now, you may be thinking to the accounting for tangible long-lived assets and saying, well, that's not surprising. For tangible long-lived assets, we have learned that these assets are carried on the balance sheet at cost, meaning we don't recognize the fluctuation in the fair value of these assets. What did we incur in terms of the expenditures to get this asset? And then we carry it on the balance sheet at costs. Isn't that also the case for intangible assets? And the answer is it's not. It's more complicated than that. If you watch my video on tangible long-lived assets, you may remember this slide that talks about the capitalization versus the expensing decision. And if you didn't watch the video, I really recommend that you go back and watch that video first before we jump into the intangibles. The capitalization versus the expense decision is driven by two conceptual questions. Do we have an asset which is either owned by the company or controlled by the company? And can that asset be reliably and verifiably linked to future benefits? If the answer to these questions is yes, then you get to capitalize this asset, meaning you will recognize it on the balance sheet instead of expensing it immediately. And whether you capitalize or expense something has an implication for your financial statements, both today, the moment you make that decision, and in the future. Let's refresh our memory in terms of the impact on the financial statements. If we are able to capitalize an asset, then the outflow of cash that we're experiencing today is going to be coupled with the creation of the asset at the same time. We're not going to have any impact on the income statement the moment that we have the cash outflow. Instead, in the future, as we're using the asset, as we are receiving the benefit from the asset, we're going to recognize the expense on the income statement, and that's going to reduce our profitability and retained earnings, and we're going to decrease the net assets. When we were talking about tangible assets, we were calling this expense the depreciation expense, and we were reducing the net asset via an increase to the contra asset account accumulated depreciation. Now, in contrast, if we are looking at the same $1,000 cash outlay, but we are determining that it doesn't qualify as capitalization and instead it needs to be expensed, then the full $1,000 is going to be hitting the income statement, reducing our profitability, reducing our retained earnings, but we don't have an asset, and correspondingly in the future, we don't have any remaining future expenses that will be recognized. Everything is just done immediately today at the same time that the cash outlay occurs. Generally, only the intangible assets that are purchased from an outside party are going to be capitalized and recognized as an asset on the balance sheet. The intangible assets that are generated internally through the internal processes of research and development or marketing and advertising are not going to be capitalized. They're going to be immediately expensed. Why have the accounting regulators in the US taken this position? They have decided that there is a large degree of uncertainty in determining whether the internally generated intangibles are actually going to be linked to future benefits. Think about a pharmaceutical firm which is undertaking many research and development projects, and only some of those projects will ultimately yield a viable product. Thinking about the marketing campaigns that were hoping to generate consumer interest, hoping to generate sales, but ultimately failed and were not successful. There is a high degree of risk, there is a high degree of unpredictability when we're talking about activities such as research and development and marketing and advertising. And here's a couple of examples of famous unsuccessful internally generated intangibles. If we go back to the 80s, we have Coca-Cola changing their secret formula after a period of testing and rolling out the new Coke. This was a very large expenditure, both in terms of the development of this product and the marketing campaign that they undertook to pull the old Coke off of the market and to replace it with the new Coke. That was not a long-lived campaign, and it was fairly costly. It is now studied in business school as one of the examples of new product rollout failures. Apple, who is very good in developing new products which enjoy a tremendous amount of consumer demand. If we go back to the 90s, you may not have heard about an Apple Newton. And that's because it wasn't a very successful product. It was a product that had some technical flaws, and it was also considered to be, in retrospect, maybe a little bit ahead of its time. Ultimately, it was pulled. It's considered to be an unsuccessful Apple undertaking. One of the most recent examples from the marketing world, we have the holiday campaign from 2025 from McDonald's that really was not perceived well because of its messaging in terms of the holidays being really not a great time. Also, in terms of the graphics, it was a bit of a flop. It was actually removed from circulation fairly quickly by McDonald's, not successful. So again, we have three companies here, which have all had a lot of successes with their research and development and marketing, but they're not immune from having some failures, from having some flops. And that is because this process is fundamentally quite risky. Let's illustrate the difference between the internally generated intangible and a purchased intangible. And we're going to do it with one firm. Take a look at this box. Do you know what's in the box? Some of you might be wondering and saying, I have no idea. It could be a number of things. But others are probably looking at the box and saying, I know it's a piece of jewelry. And not just that, I know it's a piece of specific high-end jewelry because that box is coming from Tiffany and Company. How do you know that it's a Tiffany box? It is the signature color. It is the signature bow presentation. This is a Tiffany box. Tiffany is able to command high prices for their jewelry, not just because of the gold and silver and precious stones, not just because of the craftsmanship, but because they have developed over a course of the last 100 years a tremendous amount of brand recognition and tremendous amount of customer loyalty, very large intangible assets. Let's take a look at their balance sheet, the last that we have before Tiffany was acquired. This is from October of 2020, and on the asset side, this is in millions. We see that they have cash, they have investments, accounts receivable, inventories is the largest category of assets, some prepaid expenses. By the way, all of the items that should be familiar to you if you have been watching the prior videos on my channel. We have some lease assets, property, plant, and equipment, which is our long-lived tangible assets, deferred income taxes, and other. What do we have missing from this asset side of the balance sheet? We don't have any intangible assets. We don't have anything that sounds like brand name, brand recognition, customer loyalty, etc. Now, there could be a small number of intangible assets in the other category, but that's only $300 million. It's not very large. Overall, we have just about $7 billion on the asset side, no intangible assets to speak of. They do also have a number of liabilities. So in terms of the equity, which is of course our assets minus liabilities, it's roughly $3 billion. After this balance sheet, Tiffany was acquired by LVMH at the cost of $16 billion. So very large disconnect between what we have on the balance sheet and what LVMH is valuing Tiffany to be worth. Now, after the acquisition, LVMH has disclosed something called purchase price allocation. So they told us that of the $16 billion, the different assets that they acquired, and among these assets is brand and other intangible assets worth over $7 billion. So this is an asset that is completely missing from the balance sheet before the acquisition because Tiffany has created it internally through many years of advertising, many years of marketing, many years of relations with celebrities, etc. We had a movie where a famous actress is standing window shopping, eating a croissant, looking at Tiffany. Tremendous amount of name recognition. What are some of the other categories of intangible assets we might see? Some common types include technology-based intangibles, patents, software, proprietary technology and formulas, purchased research and development. That means it's not quite at the patent stage yet, but it is somewhere in the R&D pipeline, so kind of like a half-done project. We have customer-related intangibles, customer lists, contracts, order backlog, marketing-related intangibles. That includes trademarks, trade names, as well as internet domain names, contract-based intangibles, licenses, royalty agreements, franchises, supplier contracts, non-compete agreements. All of these can be valued. Artistic-based intangibles, so these are copyrights, and goodwill. Goodwill is a specific type of an intangible asset that is created only as a result of a merger acquisition when you're buying a whole company or whole unit that can operate as a standalone company. I will cover goodwill in the next video. Again, the general rule for all of these intangibles is that if you are developing them internally, you are going to expense them. But if you are buying them from an outside party, then you are able to capitalize them. Why is that the case? The regulator said that if we are engaging in a third-party transaction, so these are two unrelated parties, and they have come to an agreement that this intangible asset is worth a certain amount of money. You're willing to sell it to me for a certain amount. I am willing to buy it from you for a certain amount. That is a good signal that this intangible is far along developed, that I have a clear understanding. What is it worth? How am I going to integrate it into my business? And the degree of uncertainty is much lower compared to something that is developed internally. For the intangibles that are internally generated, there are actually several exceptions that do allow some element of capitalizations. So let's go through them. The first exception is a general use exception. So if you are buying a physical asset, let's suppose it's a machine, that machine is only going to be used on the project that you are working on right now. And if that R&D project fails, if it's not successful, the machine is not worth anything. You can't really transfer it. It's very niche. It's very unique. Then you would treat the cost of that machine as an R&D expense. However, if you're buying physical assets that can be used for other projects, so you're buying microscopes and you're saying, yes, I'm buying them for this particular lab, but if the lab fails, if the project fails, I can easily transfer them. They are a general use asset. I will put them in use somewhere else. If you're thinking about buildings or computers, even though you might be using them for R&D activities, you can still capitalize them as long as you're able to reshuffle them and use them alternatively somewhere else in the future. Here is an example of disclosure from Laser Photonics. We acquire equipment for general use in further process and development, and we record the depreciation of this equipment as research and development expense. So as the physical equipment, which is really essentially property, plant, and equipment, is depreciated, they include part of that depreciation in the R&D. Another exception is industry specific. Only for software development, you have a delineation between the costs that are early in the R&D process and the costs that are a little bit later. So kind of the research versus the development. So we have a good illustration of this exception from a company called Datadog. We begin to capitalize our costs to develop software when preliminary development efforts are successfully completed, when management with the relevant authority has authorized and committed to funding the project, and it is probable that the project will be completed and the software will be used as intended. So as you are starting software development, as you are kind of in the uncertain stage, you do have to expense it, but you can determine that you have reached a point of feasibility, essentially, where further cost that you're doing on further development of this can be capitalized. They go on and say we stop capitalizing these costs when the software is substantially complete and ready for its intended use. So at the point that they stop capitalizing, they have this asset. Once they're starting to use the software, they will amortize it. We will talk about the amortization expense in just a couple of slides. Now, what's interesting about this exception is that it is actually similar to how international accounting standards, IFRS, treat all internally developed intangibles. This is one of the areas of more observable differences between the US GAAP standard and the IFRS is that under US GAAP, this is really kind of an industry-specific exception, and most R&D costs are expensed. But under the international rules, not just for this industry, but more general, you do have an opportunity for capitalization that kind of depends on where you are in the R&D process. Another exception that we have here is for in-process research and development. So again, these are kind of research and development projects which are in the pipeline. They're not quite at the completion stage yet. And if they're purchased as part of a bigger acquisition, if you're buying a whole company or a whole unit that can operate as an independent entity, then any IPR&D in process research and development that you're purchasing can be capitalized. You can keep it as an asset while you are continuing to work on it, while you decide if it's actually a successful project or not. If you decide that it is a successful project, at that point, you can start to amortize these costs. And if you decide that it is not a successful project, then the moment that you make that determination, you will expense that cost and recognize it on the income statement. Switching from research and development onto the marketing and advertising side, do we have any options for capitalization? Yes, for direct response advertising. So direct response advertising is when the company sends catalogs or flyers or coupons to the customers if they're able to have a high degree of predictability. If they know that out of the coupons sent, we can predict how many will be used, how much sales will be generated, then this is considered to be less risky, more predictable than kind of the traditional advertising where we're running a billboard or internet campaign or video campaigns, etc. And we are allowed to capitalize it. Here is a disclosure. Monroe Inc. says the cost of advertising is generally expensed at the first time advertising takes place, except for direct response advertising, which is capitalized and amortized over its expected period of future benefits. For them, direct response advertising is primarily coupons. Finally, we have administrative and legal fees that are associated with internally developed intangibles, and those can be capitalized. So now we're obviously at the tail end, kind of the R&D, the marketing, these things are done. However, notice that there is the word can be capitalized. So it's not the case that they have to be capitalized. Companies do make the determination. And here we have two examples of different policies. Blue Biofuels says that the company has capitalized the legal and filing fees of its patents and trademarks. In contrast, we have a pharmaceutical here that says, due to the significant uncertainty associated with successful development of one or more commercially viable products, all patent-related legal and filing fees and licensing-related legal fees are charged to operations as incurred. They're saying even for something that is viable enough to experience legal and filing fees, there's still uncertainty that comes in the future. If you capitalize them, then you have to continue to track whether this project is successful or not. And if it is successful, then you have to decide on how to amortize it. And if it's not successful, you have to expense it. They have decided not to go through the hassle of doing that. And they're saying, we're just going to take the conservative approach, even for these fees that we could capitalize, we're just going to expense them as we experience them. If you have capitalized some intangibles, either because they fall into one of these exception categories or more likely because you have purchased them from another party, then you need to think about how to treat them in the future. If we're talking about intangibles with finite useful life, meaning the intangibles that are not going to last indefinitely, you need to somehow allocate the cost of these intangibles, which are an asset on the balance sheet, to be recognized as an expense on the income statement. So for tangible long-lived assets, we did it with the depreciation expense. For intangible assets, we're going to do that with the amortization expense. It works very similar to the depreciation expense. One of the differences, and it's kind of just a little bit of a stylistic difference for depreciation, when we think about the impact on the asset side, we were recognizing the increase in the contra asset account accumulated depreciation. For amortization, we have a diversity in practice. Companies are allowed to have the accumulated amortization account, but they're also allowed to just recognize it as a reduction directly to the asset account. Both approaches are permitted, and we can't find examples of real financial reporting of both of those approaches. Amortization expense is typically computed on a straight line basis. The useful life estimate is going to be based either on legal length of the specific intangible asset, how long does it actually provide to me a benefit for, or on economic expectations. It could be that the legal benefits last for 30 years, but you're saying, well, I'm really expecting to only sell the product associated with this particular intangible asset for 10 years, so it doesn't make sense for me to stretch the useful life to 30 years, the full one. I'm going to take the shorter, more realistic economic one. The residual value of most intangible assets is 0, which makes the calculation of the amortization expense even simpler than for depreciation. One less assumption, one less judgment that needs to be made. What about assets with indefinite useful life? These are the assets that don't have a limitation in terms of either the legal protection or the economic useful life of them. For tangible assets, we had an asset like that, land. There's actually also potentially artwork that falls into this category, but generally tangible assets, they're just going to wear down over time. So we think of them as having a finite useful life. For intangible assets, we have a slightly bigger grouping of assets that can continue to provide to us benefit over perpetuity. Trademarks and trade names, although technically these are issued for 10 years, the US government allows their renewal to be indefinite. That makes them an indefinite useful life asset. Licenses is the same. Franchises, depending on how the contract is written, could be indefinite useful life. Domain names, again, as long as you renew them. And goodwill that we will talk about in the next video, also indefinite useful life. You do not need to amortize them, just like we do not depreciate land, but you do need to evaluate them for impairment. In one of the future videos, I will talk about impairment testing and implications for both tangible and intangible long-lived assets. Now, last point here, crypto-related intangible assets. So the accounting for crypto has been evolving really fast, obviously, and this is the guidance as of the end of 2025, the latest one. It was determined that crypto assets do not belong in the grouping of financial instruments. There is no contractual claims there, so they're not the same type as either currencies, they're not the same type as equity securities. Instead, we're going to treat them as indefinite life intangible assets, but there is going to be a significant distinction for how we treat crypto as opposed to other intangible assets. When we purchase them, we add them to the balance sheet at cost, but subsequently, as they experience fluctuations, we're actually going to fully reflect that volatility both on the balance sheet and the income statement. As these assets go up in value, you will increase the asset account on the balance sheet and correspondingly recognize unrealized gains on the income statement. As they fall in value, you will decrease the asset on the balance sheet and recognize the losses on the income statement. So that is, of course, a big difference from any assets, both tangible and intangible, that we have talked about in this category. There we have it, an introduction to intangible assets. In a future video, I will talk about goodwill, which is a specific type of an intangible asset, and I will also talk about the sales of both tangibles and intangible assets, as well as impairment testing. I hope that you enjoyed this video. Please like, subscribe, drop me a comment if there's certain topics you'd like me to cover, and I'll see you in the next one.